what's happening in corporate bonds? Last time I spoke to you, you were looking for a bit of a bubble to pop. Right now, we're seeing spreads, at the high end of the junk scale extraordinarily tight, and then we obviously widen out substantially, but there seems to be some kind of a mismatch.
The bubble is getting tighter, and the fact is BB high yield bonds are trading at the lowest yield in the history of the high yield market, and that's ever, at a yield of 3.65%. And so returns are stellar this year, and the high yield market's up 14%. Due to three primary reasons. Number one, high yield came into the year, because you'll recall last December, this time last year, how cheap high yield had gotten when the markets were for sale. And so high yield came in very cheap. So 5% was the tightening from last December's losses in the marketplace. 5% was due to the coupon, and about 4% is due to lower rates, or the rally in the 10-year note and 5-year notes that have benefited fixed income high yield bonds. And so without that wind to your back for next year, for 2020, I believe high yield will struggle to make its 5% coupon. Certainly no spread tightening from here, given how tight it already is, the index. And given that we believe that rates can inch a little higher, not lower, we think you get very little duration boost. And so we believe that high yield is fully priced at the current market. In fact, so fully priced that the prices are trading at call price, which means essentially the prices can't move higher or the bonds will be called.
So what do you do in a situation like this? You've got plenty of money to deploy, more money every day, and yet you say that prices can't go higher. So
we're looking for a few things. Number one is we're looking for a reallocation of how we purchase assets in the capital markets from high yield to structured credit. RMBS and CMBS, we think, are greatly benefited by a strong housing, strong consumer market, and strong leasing market. And so we think that will continue to be the case in 2020 with very cheap cash flows going in, good Sharpe ratios on performance, and we believe an undervalued asset class, underappreciated, because the 2008-2009 era for structured credit still wanes heavy on people's mind. But when the bubble does pop at some point in the distant future, when that happens, it'll be more about a high yield leveraged loan story than it will be about a structured credit story. We think that's solid as rock.
What happened, Bruce? Why is it suddenly the distant future? I mean, distressed funds have been bailing out companies all year, from PG&E most recently to Mallinckrodt, Frontier. What happened?
Well, it's the haves and have-nots. The BB market is doing quite well. Having said that, there's a huge credit rationing that's going on right now today, and began just in the last several weeks, where CCC companies that are lower rated and more highly levered are trading at an enormous difference between BBs, where BBs are trading at the spread that they're trading at in the 200 range. You have the CCC market trading about 1,100 off. That 900 spread between the two indices, CCC and BB, we've only been this wide 3 times this millennium, this last 20 years. And so what I'd say is this credit rationing is happening. We're seeing more downgrades than upgrades in high yield, but yet the stronger credits are doing well. And we're seeing this bifurcation that currently exists that's going to lead to higher default rates down the road, because credit is now cut off from a lot of these CCC companies.
Robert Kaplan of the Dallas Fed was in yesterday. I was actually asking about this. He said that he wasn't so much concerned about the CCCs being at a 900 basis point spread, more the double and triple Bs. They were keeping a very close eye on that the market is mispricing those potentially. So this credit rationing that you speak of, why is the market failing? Is it unable to distinguish good risks from bad risks?
Well, first of all, I'd focus on both. I'd focus on the fact that default rates will go up because of what's happening in this credit rationing in the CCC marketplace. But I'd also focus on what Dallas Fed Chair had said, which is spreads are a bit tight, but leverage ratios are significantly higher. So if you look at Moody's and S&P, you look at a single A rated company and compare that leverage ratio with any other point in time in history, those companies are so much more levered today than they've ever been. You do the same thing in BBs, BBs, single Bs, you'll see the same exact story. Companies have more leverage today than they've ever had versus history.
So when do we see the ratings cliff? When do we see credit being cut off? When do we see a wave of bankruptcies?
Well, I think the U.S. economy now is going to have a spurt upwards in growth compared to what was just expected a couple months ago. So number one, the Fed did lower rate by 3 times, 75 basis points, and that's beneficial. But even more important to that is these trade wars have now become, have now been settled. And so the U.S. and China, Mexico and Canada, and that's clarification for the market. Brexit now and the referendum that Boris Johnson has in the UK is all highly beneficial to global growth. And so I think the growth trend is firmly in place for 2020. So I don't think it's going to be a growth recession. I think it's going to be a earnings recession. And so we're starting to see a negative quarter this past quarter of earnings growth being negative, and I think we'll see a couple more quarters of that in the early part of 2020. And when earnings go down, that's going to be a very key point for some of these companies that are so over-levered when they have lower earnings and meanwhile have to service these heavy load of debt.
So just to clarify, you're saying there will not be an economic recession next year, there will be an earnings recession, and economic recession is staved off until at least 2021?
We think so, yes.